has to become less costlier. In addition to this, in my own estimation, financial innovation must also contribute to better management and transfer of credit risk, the unbundling and tranching of risk, the improved liquidity positions, optimal portfolio diversification, and broad credit risk dispersion. Now, these are the challenges, and financial innovation, as you would possibly as professionals know better than I would do, is not without risks, because it invites a lot of attention in terms of creation of newer risks as you go around with innovation. And I think the US subprime fallout is a major classic example. Innovation that does not, or regulations and practices that do not match with innovation, will put into jeopardy possibly the small-time investors, the small-time borrower. And consequently, you can have transfer of risk to rather unknown counterparties in the marketplace, leading to instability, particularly when the emerging market is relatively small in comparison to other markets. Now, their ability to transfer risk, when it becomes easier, there is a likelihood that the debt originators might become less diligent, and the investor might be lesser aware of the consequences of his investments. And therefore, consequently, you might have a situation where the advantage of emerging market and its financial innovation does not tie in well with the expected level of regulation that is necessary to match the innovation of the market. The emergence of the fixed income market is, in the context of our own markets, is a recent phenomena which gained more traction following 1970. We have had a perpetual cycle of crisis that emerged following the debacle in 1971, when we lost half of our country. Since then, there has been a financial system that has gone through various periods. Now, catering with this idea and identified with the addition of a fixed income market as an alternate source of funding through banking and equity sector, with this perspective in mind, the development of the financial fixed income market has attained greater importance in the new financial market architecture. Financial markets are expected, ladies and gentlemen, to mobilize savings, efficiently allocate these, and allow for foreign inflows to the most productive segments of your economy. They have to be efficient and must have access to your own markets, which will always and continues to remain a very crucial element in the undertaking of substantial investments that are needed to stimulate the economy. In the pure context of our country, I could divide the financial market development into essentially four segments: the 1947 to 1960 segment, the 61 to 70 segment, the 71 to 90 segment, and the 1991 to the current environment. The period between 47 to 60, we saw private sector development taking place. However, this trend was overshadowed during the 60s, when we saw public sector development take more initiative in the marketplace. And this trend sharpened during the period 1971 onwards till 1990, when government predominantly started operating in the business arena. Even the banks got under the clutches of the government control. Post 1991, of course, there has been a period that we have witnessed liberalization that has taken place. Now, this particular aspect is where the market moved out of private businesses and moved towards more market-based reforms. Now, the growth of the fixed income market in Pakistan also followed a similar pattern, i.e., the private sector development, the nationalization and liberalization that we saw in the post-independence period to 1990. This initial phase lasted up till 90, following which, at which point in time the federal governments and the provincial governments were quite used to borrowing money on tap instruments with predetermined rates. When I started off my career, that was a time when instruments used to be issued by the government of Pakistan on tap basis. And I can assure you ladies and gentlemen, life was such simple, life was so good out there, and it was not very long ago, I can assure you for that. Don't consider me a fossil. But situation was that you could go whenever you are flushed with, as a financial institution, with liquidity. You always had the counter of the central bank, go and dump your cash there and collect a treasury bill of any amount that you wanted, at a fixed predetermined price of 5.75%, if I remember it correctly, and it was a discounted price on which you bought treasury bills. The lending rate was also kind of predetermined. Bank rate, since my school days, remained at 10% and continued to remain so till about 90, I think. And the maximum amount that one could lend money at was fixed at 4% over the bank rate, which was 14%. So you had an investment of surplus funds of roughly at 5.75%. Add to that cost of your deposits, which were in the region of anywhere between 6 to 7%. So each financial institution had a neat spread of 3 to 4%, as against the current vulgar environment of some of the large financial institutions enjoying 8 to 9% spread. Now, in the context of that era, therefore, what were the statutory preemptions that were available for the central bank? Largely, they were to increase either the statutory liquidity ratio or the cash reserve requirement. So there was very little scope left for the development of the government securities market in Pakistan that could provide benchmarks to the private sector to play their role in the development of the capital markets. Now, to cover the non-banking segment, a new kind of an instrument was launched in 1960 by Pakistan, and that was the price bond, which was followed by other national savings scheme products. However, there were no alternate to the market-based instruments, as they were also all on tap, i.e., you just had to go and open the tap and take as much instruments as you had the money to buy. During the 1990s, when market-based instruments came in, starting with the Federal Investment Bond, which was first launched in 1992, the long-term yield curve came into being, and that gave an opportunity for the corporates to start benchmarking their borrowing. And in 1995, the first issuance of the term finance certificate took place by packages. However, actual momentum was really 2000 onwards, with the introduction of the long-term instrument, i.e. the Pakistan investment bonds. But the pace, ladies and gentlemen, even now is extremely slow, and we still have many challenges to overcome. This essentially brings me to talking about, very briefly and very quickly rather, of what are the essentials for developing the fixed instrument market in Pakistan. Now, the first and the most critical area that needs to be addressed is to have a well-functioning money market, which must knit in very well with the directed money market operations. The monetary tools currently being used are auctions of government securities, open market operations, reserve requirements, swap and discount window that is being continuously used by the central bank as a mechanism of operating in the money market segment. However, the most effective tool currently being used is the OMOs alone, that are called by the State Bank of Pakistan as and when they desire, looking at the market and the monetary aggregates by adjusting them. But for interest rate signaling, what has happened is that the auction of the treasury bills has become more or less the benchmark, and the 6-month treasury bill has largely now come to be known as the identifying factor for corporates to align their rates for borrowing from the financial sector. Some suggestions out here. In order to have an improved money market situation, in conjunction with monetary policy implementations of the regulator, they would have to go about to improve management of government cash flows, to maintain better liquidity management by the central bank, and 2, assurance of securities for both monetary and fiscal policy purposes. If they can distinguish that, it would help the market attain some kind of maturity.